There's one single price pattern that's responsible for more traders' losses than any other price pattern out there. I'm going to show you how to spot that pattern. I'm going to teach you what it means, why it happens, but better yet, I'm going to teach you how to use that pattern to actually amplify your profits. Let's get into it. This is the master pattern. What the master pattern is, it is a series of 3 market phases. You could look at any market. I don't care if it's stocks. I don't care if it's Forex. I don't care if it's crypto. Anything that has high trading volume, you will spot this pattern in. Now, I didn't invent this pattern. There were smarter people before me, but this is my interpretation of that pattern. So it starts with contraction, then it goes into expansion, and then it goes into trend. Those are the 3 market phases. What we're going to be drilling down on today is the second phase, the expansion. This phase right here, if you don't understand this phase, will result in more losses than you want to take. So I want to break down, what is this expansion? How does it work? Why does it happen? And better yet, how can we use the expansion phase to position ourselves for making more money? So let's get into that. So here's our expansion phase. Why could a trader possibly lose a lot of money in this type of market condition? It's actually pretty simple. If you look at our contraction, this is what establishes what we call fair market value. Why do we call that fair market value? Because right here in this part of the 3 market phases, buyers and sellers have agreed upon a fair market price. That's why the price contracts into this point. But when it leaves this point, that gets disrupted. When you start trading above that price and below that price, you start swaying traders to either side of the market. Now, why would that be? Because traders want to chase breakouts. Traders value confirmation over quality trade placement. So therefore, on each side of this line, you have traders coming in and buying the market and then selling the market, and then buying the market and then selling the market. And those traders that are selling the market, their stop losses are up here. The traders that are buying the market, their stop losses are down here. They continually try to buy breakouts that are above value, sell breakouts that are below value, while putting their stop loss on the other side of the range. And if the market doesn't actually break out, then they just keep getting stopped out over and over and over again. You can lose a lot of money in this type of market if you don't understand this is happening. What do we need to do? We need to correctly identify that we've entered the expansion phase. How do we do that? Again, quite simple. We need to first correctly identify the first market phase, contraction, and then by definition of 3 market phases, we would enter the second phase of the market by leaving the first phase. When does that happen? It happens right here when we come out of the box. But how do we know we are for sure in an expansion phase? Very simple. We need to establish the first 2 expansion legs. What are those? Well, right here coming out of the box, that is your first expansion leg, and that one is sealed in when we establish the second expansion leg, which is coming down through the bottom of the box. So we need that 1-2 leg price action to show us that we are for sure in expansion. Now, when this happens, the question is, how long is this going to last, this funneling out action? When will it actually break out? Because that's what we're really interested in. How long an expansion phase will last, meaning how many expansion legs will happen until the market actually breaks out, is dependent on one major thing. That is the higher time frames round trip speed. What is round trip speed? Round trip speed, or a round trip, is the beginning of a trade idea when you actually push the button, or anybody pushes the button, gets into a trade, lives through that trade for better or worse, and then closes that trade. So from opening to closing is your round trip. Now, the speed in which that happens is what controls breakouts. Let me explain. The most common thing that's going to control a trader's round trip speed is going to be, by far, chart price action patterns. So in our expansion phase right here on our example, let's pretend for a moment that this is a 15-minute chart that is going through this price action. If you have 15-minute traders looking at the same patterns as other 15-minute traders, their round trip speed is all going to be about the same. It's going to be a handful of 15-minute candles. So when we get to the tops of these ranges and it doesn't break out, they're all going to sell at the same time. When we get to the bottom of these ranges and it doesn't break out, they're all going to get out of that position at the same time. What needs to happen for it actually to sustain a move? This expansion phase on the 15-minute chart will not end until the hour, the 4-hour, the daily, the weekly, the monthly traders, those higher time frames, get into the market. Why is that? Because we need their round trip speed and their transaction to stabilize the market. Think about it. If the market breaks out and all the 1-hour traders or the 4-hour traders jump in, they're not going to close that trade for a handful of candles minimum. That could be multiple days for the 4-hour trader. It could be multiple weeks for the daily trader. It could be multiple months or even years for the weekly and the monthly traders. We need them to see something significant enough on their chart to execute their trade. And with the stability that they bring to the market direction, that is what will cause a sustainable breakout to actually happen. So at this point, you should understand these two things. Number one, you should understand when the expansion phase starts. You should be able to spot that first and second expansion leg coming out of the contraction area. Number two, you should understand to some degree what controls how long the expansion phase lasts, which is the higher time frame commitments coming in to the market. Now, the key with all this is not only to avoid doing the wrong thing in this area, but to flip that completely on its head. How can we take this area right here and use this to our absolute advantage to get amazing entries into the market? And that brings me to the funnest part of this lesson, which is the basic strategy. The way that you're going to trade in this expansion phase and not lose money, but more importantly, have the ability to make much more money, is you're going to do it with a directional bias. What does that mean? Well, in our example right here, you can see I have a daily chart illustrated right here, and I have a 30-minute chart illustrated right here. Now you can use a 5-minute and a 4-hour. You could use a 15-minute and a daily, a 30-minute and a daily. You could use a 4-hour and a monthly. It really doesn't matter. The concepts all work the same. So on this one, we have the daily chart, which we've identified the first, second, and third market phases. So what you want to do is you want to take your higher time frame and you want to find one that is in the trend phase. When that is in this trend phase right here, then you want to look to your lower time frame. In this case, we have our 30-minute chart, and you want to find the most recent contraction period that has happened within that trend phase. When you see this box happen, by default, we expect that the trend phase is going to be to the long side. Why would that be? Because the daily, the higher time frame is in its trend phase. And like we talked about before, the higher time frames control the stable flow of money in those directions. So we already expect that the outcome of the 3 market phases of this box is going to be to the upside. So what do we do in expansion? Because by default, we expect the trend phase to ultimately go long, we trade everything that goes below value to the long side, meaning that you're going to buy. Every time you get an expansion leg, no matter how many there are, you continually buy below value in expectation of the predictable outcome, which is the market to continue in its higher time frame direction. So you buy right here, you can add a little bit more right here, and then you sell here. Now, what's the big epiphany with this model besides this? The big epiphany here is that this is exactly how the banks trade. The banks accumulate discount inventory and then distribute it into the expected trend. So by trading this way and adopting this style of trading, you are by default trading in line with how the banks do their business. So I know you're probably thinking at this point, what happens when that ends? When the higher time frame reverses, don't I lose now? Well, the market will eventually reverse. This will eventually stop. But here's the cool thing. By staying positioned under value, even in the event of a reversal, the market will continually come up to value, usually several times before you get a major reversal. And by positioning yourself under value, you will have the ability to at least close out your trade at that price level or you will be closer to your ultimate out. So you're never going to be risking more money than a trader that continually trades a breakout and does things in the wrong way. The daily chart on gold is a perfect example of what I just explained back there on the whiteboard. Let's take a look. So if we go right here, we're looking at the daily chart and we have the 30-minute chart right here. We can see that we have the confirmed contraction zone, which started right in here. And then we broke out of that contraction zone. Here's our first expansion leg and then our second confirming expansion leg. At that point, we know we are in a multi-leg expansion. So we can expect the activity that's coming just like I drew on the whiteboard. As we saw it trade up through here, we could see that it trades back down through our established value point. That's this white line right here on our software. It trades down through the swing low liquidity, giving us another expansion leg. Then the daily creeps up, takes a few days to settle at value, and then boom, we see this explosion into the trend phase. This happens over and over and over again. So there was plenty of opportunity to trade up through this first leg, but I'm going to specifically zoom in on the second leg of the trend phase on the daily chart, starting right here. This was our first contraction point that was confirmed after the daily had confirmed that it was going back into an uptrend in the trend phase of this overall cycle. So right from the moment that this box was created in there, we have a default judgment that the third phase of the three market phases associated with this box is going to play out to the long side. So let's take a look. We have the market come up, it traded down below, and you can see it's holding below value. It trades up through it and ranges out a little bit. Then we get another contraction phase. Now, it is possible to have groups of contractions that communicate together, groups of phases. So that's what happened here. We can see that we have another one that forms kind of at the same level. We go through the expansion phase, same thing, trying to get positioned under that value, because we ultimately expect both of these contraction points are going to result in the market heading upward. So as the market trades below, you can see, boom, it explodes through both of those value points and then goes into a big trend. We'd see we have another value point that's established right here. Market trades up, trades back down an expansion leg, grabs that liquidity, ultimately goes up. Right here, we have another contraction point. Market trades up, trades down below. Now we're trading below value. Again, more discounted liquidity coming in for the banks and market makers. Buy that up, trades back up. You could see that every single confirmed contraction point through here, when the market traded below, started to go back up to value and through into the next trend phase, right up to where we are today. So we could see we had this contraction point up here. And like I explained on the whiteboard, eventually we will get a reversal. The daily will turn, and this very well may be that point. But as you can see, we have this contraction that confirmed up here at the top. Here's our fair market value. You can see that price has come and traded back up to that value point, and it's trying to get through, but it hasn't had success. This right here is an indication that the trend may be over. Therefore, what is happening right now is not a big surprise. The market will give you clues and warnings before it actually turns if you know what you're looking for. So that's what I got for you today. At the very least, you should now understand this pattern just enough to hopefully help you stay out of some sideways market conditions and not take the losses that most of the other traders are taking in those market conditions. At the very most, I hope you learn this pattern and use it to really get great trade placement and entries into already existing trends. Hey, also, if you like what I talk about, pretty much I talk about it all over my YouTube channel. So make sure you check out some of my other videos. Also, if you want to go through our brand new Master Pattern Academy course, it's over on my website, tradeats.com, for free. Go over there. It's 12 lessons, about 8 hours long, and it talks about everything having to do with this. Go over, get it. It's free. I made it for you. So other than that, thanks for watching the video. We'll catch you on the next one.